Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. We are recording this on Friday morning, April 3rd. It is Good Friday, so happy Easter coming to all of our listeners. And again, it has been an eventful week, so probably appropriate that we're taking a holiday in some countries here to digest. I'm delighted to be joined by Christian Abuide, who's based in Geneva and is a macro strategist with experience in the OCIO arena. Welcome, Christian. Thank you for joining us here.
Pleasure to be with you, Evan. Thank you.
Well, as usual, I'll bring up the slides. Great. Well, I've called today's podcast with a nice picture of spring from FOMO to fortitude, as it did seem to be the case that markets were experiencing a little bit of FOMO in terms of not getting in on some of the de-escalation around the Iranian war. But just as we speak, this is very much a dynamically moving target. Fortitude has, of course, been the name of the game in markets for some time now, and there is a lot of underlying fortitude despite the geopolitical turmoil. As usual, we go through the 5 topics of inflation, interest rates, geopolitics, equity markets, and other asset classes. And some of the sub-themes we're going to speak about today: inflation staying in check for the most part, with the exception of the recent geopolitical surprise. We will ask, with connection with the oil price, a question I was asked on Bloomberg this week, which was how long before we start reaching demand destruction. And we will start talking about some of the repercussions we've already seen around the world in terms of the effect of high energy prices. We will look at government bonds and look at how some are back in demand, maybe as safety assets, but others still seem to be undesirable. Back to the equity market topic we discussed before. And as always, we will revert to the portfolio impact. This is our guest, Christian. He's a Geneva-based macro portfolio manager and asset allocation consultant with over 20 years experience managing multi-asset portfolios and asset allocation strategies for major international banks. We have met a few times now, but more recently in London, and I've really enjoyed our macro discussions. So look forward to debating them with you here, Christian. And firstly, let's kick off with inflation expectations. So you're based in Geneva, I'm based in London. We've seen some different inflation scenarios play out in the UK, in Europe, as well as in the US. And it seems that despite the fact that we've had this short-term spike, we seem to have long-term inflation expectations still settling for lower. So whether these just have not adjusted yet for a potential protraction of the Iranian war, but it does seem equally that the forecast for 2026 inflation, although higher than previously, we are still trending down when we look to 2027. So I'd love to hear your perspective. You're obviously based in an expensive country anyway, Switzerland, but how do you see the inflation expectations playing out? How do you see it in the consumer? And do you think that we are perhaps being too generous in thinking that this spike is just a 2026 phenomenon?
Yeah, I mean, I think it's an excellent question. And by the way, thank you for having me on the podcast. Yes, I mean, I think there are a couple of effects to take note of. I think the short-term impact is unequivocally for higher inflation, and that applies to different degrees for various reasons to pretty much all countries, right? So we know that certain countries and certain regions have a higher propensity to pass through from oil prices, and obviously the longer the conflict lasts, and even if it didn't last any longer than now, there would be an impact. So I think directionally, and you see that in basically the table you're showing from the OECD, the impact is clearly for higher inflation. Now, the second part is what happens after, and that's the one that is, I would say, the more relevant one, but also the very difficult one to call, because that depends on the duration. You alluded to this earlier when you mentioned demand destruction and when does that kick in. So the length of the Iran war will determine obviously the extent and magnitude of the supply shock from energy and the pass through to inflation, right? So I mean, I think we have seen both in the UK, in Europe particularly, but also in the US, 1-year measures jump up in terms of inflation expectations. And this is both for the consumer, which you mentioned. We saw Michigan data last week, and basically you saw the 1 year clearly moving up, the 5-year stable. So similar to your point, but we have also seen something or similar dynamics, I would say, in market-based measures. So if we look at inflation swaps, break-evens, the 1-year measures have clearly moved up. And again, the US has been part of these dynamics. It has been more exacerbated in the UK and Europe because obviously they have a higher dependency on whether it's gas or oil or both. But yeah, I mean, I think there will be an impact. I think the impact clearly is higher inflation. I think there is the risk of complacency, but that's not just for inflation; it's for probably everything else that falls as a result of inflation rates and what happens to portfolios if the conflict escalates or lasts longer, and what that would mean, right?
And a really interesting point. I think let's jump into that demand destruction point now, because that really does have a major knock-on effect on the economy, on the vibes. Just quickly before getting to the demand destruction, so let's just look at what has happened to the price of Brent crude. So clearly, dramatic increase at the start of the war. It's had some volatility since then. And now we know it has started to affect where it really matters for the American consumer, which is at the price of the gas at the pump. Perhaps more than any other consumer anywhere, the American consumer highly dependent on that. And it's also very symbolic, of course, as well, the price of gas per gallon. It will generally move sentiment, and certainly the president is focused on that in the US. And then this idea of the demand destruction. So we first seen the kind of the shock absorbers in terms of the stockpile, some of the supply being soaked up by stockpiling on the part of first oil companies, and then strategic reserves by governments. Now we've seen governments act in terms of having the excise duty. So to have that, in the case of Australia, that is obviously a lever that many governments have. But remember, the exact knock-on effect of that would be obviously on the tax revenues, which is something that many governments have very little room for error when it comes to their certain budget situation. And I've just seen recent headlines of in Malaysia switching to remote working, as in the case of COVID, in order to keep the demand for fuel down. So that could have a major symbolic, I think, psychological effect if we were to see that type of spending contraction. And as in the case of COVID, we may end up with the shifts to whether it be a shift to online everything, purchases. But then if the fuel is the issue, well, then maybe transport logistics cannot keep up with online demand. So that's another knock-on effect. I have a chart here showing the climb in the price of aluminium, which clearly an important input. We've seen helium, we've seen fertilizer. So this could perhaps, as you said, be quite seismic in terms of the effect on sentiment as well as on other sectors. Do you think we're at this demand destruction point yet?
I have no way of justifying this, but I would feel that probably we are at the beginning of that demand destruction point. Yes, I mean, I think we are 5 weeks into this conflict and into this disruption. Certain countries have taken certain successful measures to sort of alleviate that. The case of Saudi Arabia and redirect into the Red Sea, or ports on the Red Sea, as opposed to ports and transit through the Strait of Hormuz. But the fact remains that yes, you had some ships basically in transit; those would have arrived. You have some stockpiling domestically, and also partly release internationally. That is a palliative, and that's helpful. But eventually, I mean, you highlighted a couple of real life examples from different countries. The rhetoric and the messaging seems to be, you need to prepare for this to last longer than we would like to. I mean, it's not a question of what we would like. I mean, I think everyone will agree the conflict we would all like the conflict to be resolved immediately, right? For moral, humanitarian, and reasons more than financial ones. But that might not be the case. And if that's not the case, eventually, I mean, these are spot markets, right? So either the price adjusts, and usually that's why you have the spike you have, until demand destruction kicks in and sort of brings the market back into equilibrium, right? So I think we're going to see, that's the risk that we are going through. We're going to see, if the conflict persists, we're going to see that sort of creep into real activity. And we talked about inflation just a minute back, but this week we saw the inflation print in the Eurozone that already showed the first, and that was for March, right? That already showed the first tick up in inflation data. So again, it's not going to be a huge surprise to anyone that it moved up. Next week, I think we're going to see, next Friday, we're going to see CPI data in the US. That's going to be for March. Everyone is going to be looking at that. So the question is going to be how much does it move? But then again, it's still not going to resolve the big question, because the big question is the one that we cannot answer, which is how long does this conflict last? As a result of that, the impact we're going to have.
And of course, that gets to the whole uncertainty that is prevailing through markets. And this has been a recent theme over, say, the last few weeks here around stagflation and the potential for this to lead to stagnation. We've already seen that that flag been raised in the UK for some time. Inflation, if we're talking about higher expectation 26, I think maybe this uncertainty could inject some stagnation. We do have more slides later about what is underpinning the US economy in particular, why it's been resilient. But if you think about stagflation, even if it's temporary, do you think, how would you insulate portfolios from that? And do you think about that in a kind of broader context?
It's a great question, and I don't think there are that many options. I would say from a portfolio construction point of view, it's probably the regime that is the most challenging to position for. And we have had just a sense of that again in March. It was a sort of a deja vu of 2022. Say most portfolios, and if you think of the market portfolio in terms of market capitalization and what represents, which asset classes represent most of what people own, one way or another, is bonds and equities. So when bonds and equities fall together, you have a problem, right? Most people would have a problem. Whether it's a 60-40, 40-60, 80-20, basically you suffer, right? And the reason behind that is inflation, because when basically if inflation moves up more than expected and by enough to change expectations around interest rates and create enough of a surprise, which is exactly what has happened now and sort of what happened in 2022 in a different context for a different reason, but the dynamics were similar, then obviously both assets, both equities and bonds reprice lower. So what can you do for that? I mean, if it is transitory, I think there is not a lot to do, because typically if we were to say, okay, this conflict is resolved tomorrow, flow of oil normalizes, which is a big if, but let's assume it does. Historically, geopolitical conflicts tend to basically not be too impactful on market performance. Markets recover pretty quickly, and you would expect the oil price in that case to correct back to, say, $80, give or take, 70 to 90, but call it 80. Equities recover, and basically the position, the confluence of factors that you had before the conflict was constructive enough, right? So you would want to still be engaged in risk, and you would still expect equities to do well. You would expect bonds to recover, in that case, from basically the moves high in rates. Rate is tight, but we'll do okay. But that's one scenario. Yes, the other scenario is very different, right? So like, what do you do outside of bonds and equities? And basically, well, commodities is not the easiest of exposures to have for access reasons or for rolling cost reasons, but it's one that makes sense. There are some commodities, whether it's gold, whether it's copper, where you have structural demand stories, where you have an angle to say it helps diversify portfolios and helps preserve value in a potentially stagflationary environment. Then it's exposures to energy, and probably I would say that is through mostly equities rather than directly owning oil, or basically buying oil as a financial asset. And we have seen expectations obviously move higher, being revised upwards for energy companies, as you would normally do. But that's a small sector in the context of the equity market, right? And then you can obviously try to manage your duration exposure, lower duration, basically floating short duration, high quality credits. So it's a move up in quality. It's a move towards shorter duration. It's a move towards safe haven currencies. The US dollar, we can debate whether the US dollar is safe haven, but I think going back to the US dollar, and again, this goes very much against the prevailing consensus coming into this year and into the conflict, but potentially diversifying with Swiss francs. But there is not a huge degree of options. I mean, I think if you have access to private markets, infrastructure is one that makes a lot of sense. because of the link to inflation pricing, because of some of the tailwinds structural that infrastructure allows you to play. But it's a very different portfolio. It's not a portfolio you can then unwind very quickly and reposition. So it's sort of like the K economy, but in portfolio construction land. So I think it's difficult. I don't think people are basically taking all into one, all into the other. So there is a lot of wait and see and managing at the edges, I suppose. And I think that makes sense.
That's an excellent point. And I brought up this slide when you mentioned the 60-40 portfolio and harken back to 22, because clearly this has been a bad month for 60-40. I would question, looking at this portfolio, how many people actually still hold 60-40? Is that kind of a relic of times past, in that with bonds being such low return for some time, and with the appetite for risk we've seen for some time, who still owns 40% bonds right now is my question. As I've seen the portfolios I've seen, generally they don't hold more than 20% in bonds. So it has been an interesting shift. Many of them hold what you mentioned before. And I think just to turn to bonds and interest rate expectations. So getting back to where we were before the outbreak of hostilities, we know that we seem to be on a rate cut trajectory, although we were looking at some pauses. We'd had expectations of up to 3 cuts in the US in 26. And the Fed had seemed to be sticking, this was back at their previous decision, with plans to cut rates, even as the Iran war, even at this point, had started to send energy prices soaring. We did see then that strange phenomenon reflected in March performance, that US borrowing costs had climbed. And this was perhaps a sign of what we've spoken about, the massive cost of some of this defense spending. It was a budget that was already stretched to the limit, and a sense perhaps that this wouldn't be sustained. And then this was a contagion effect around the world, in that we saw the gilt yields had jumped in the UK to beyond the level they had been in 22 during the Liz Truss economics affair at the end of the year, and that Italy was keeping pace there, but the US was also high, but that elsewhere, such as Germany, we still had long-term yields, 10-year in more in a 3% limit. And then looking also then at the second chart here, which was the central bank holdings of treasuries at the New York Fed, the foreign central bank holdings had been declining. So this gets to, again, we talk about demand destruction in the case of oil. How about demand falling in the case of treasuries? So it does seem that bonds had been really taking a hit initially. But as I've mentioned here, this sense of shape shifting. We'd gone from having the bonds sell off to now seeing just recently, just in the last few days, an increase in demand for bonds, on the risk that there would in fact be those rate cuts that have been promised before. And finally, to say on bonds, before turning to you, I do think it's interesting again that volatility has remained so low. So despite bonds kind of shifting in shape from selling off to now being in demand on the government side, we are still looking at fairly low levels of panic in the bond and the stock market, which is well below extremes, as we've shown here. So I'd love to get your thoughts on what's going on here in the bond market. We talked about safety assets, and they're not really safety assets, but now they seem to be back in demand again.
Yes, I mean, I think clearly there are a few things to think about when we think about fixed income, and I think obviously March is a break with basically how we came into this conflict, right? So positioning and bonds, same way as equities, but particularly bonds, got caught in that change in narrative and that change in positioning through this exogenous shock. So we talk about inflation, what that meant for the repricing, and you're right. I mean, the repricing was substantial. I mean, I think we discussed this in the past. My view was, and some other people's obviously views coming into the year, was that maybe the consensus pricing was a little bit too optimistic on rate cuts, particularly in the US. But we were clearly in a situation where I think by most accounts, inflation was still high, but you had still a disinflationary path in play. It was slow, but it was happening, where basically the labor market was kind of in this low hire, low fire type of equilibrium, where the Fed expressed a desire for accommodating monetary policy further and lowering rates if allowed to. And obviously now the dynamics have changed now. So if anything, I think to some degree, potentially they have changed maybe a little bit on the other side. And maybe the UK is a case there where we have gone from markets pricing accommodation to now markets pricing significant tightening on foreign monetary policy. And I wonder if that's going to come to pass, because we need to keep in mind that, again, yields haven't corrected fully, and they have actually been coming into this conflict in a fairly narrow range. I mean, say if you take US yields and you had it in one of your previous charts, you were in a range between, say, 4-ish to 430 just before the conflict, and a broader range of 375 to 450. And we had been in that sort of range for quite some time. I mean, we're talking well into 2025 and 2024. So there were already a few different things playing into that. The short end was impacted by expectations of potential accommodation that has changed. The long end of the curve was impacted by fears around the fiscal position of most governments, including the US, and now the risk for further fiscal easing if they need to prop up the consumer or try to insulate the consumer to some degree, or if they continue with plans for rearmament and defense spending, basically points you in the same direction. Like you have higher term premium to be expected, basically more issuance on the long end, and that has kept and continues to put pressure on the longer end of the curve. So you have this dynamic. Now, we cannot forget that you mentioned demand destruction at the beginning of the podcast, right? If this conflict persists and inflation remains high and you have demand destruction, that eventually means economic slowdown, right? So it's difficult to think that central banks will focus only and exclusively on fighting inflation when basically if the economy decelerates, you should probably try to accommodate because you will need to cushion the blow. So I think what you describe as more demand recently, I think it has to do with that, with the market rotating the focus on what is the biggest risk. And the biggest risk for the most part in March was the inflation shock and how long that lasts. And then more recently, sort of the focus has sort of started moving towards, okay, what does that mean, right? And at what point do we have consumption spending slowing down, growth slowing down, the potential impact on equities, and basically central banks having to cut rates as opposed to hike rates. Now, there are shades of gray in these. There are different mandates. So the UK and the European, the ECB have a different mandate to the US, and they are all three in a different position from Japan. So I guess, and I'm trying to tie this into your earlier question, I think the way to position when you consider that you have two broad scenarios and then you have within that different forces, cyclical and structural, potentially affecting this, is try to find positions that can help portfolios across different scenarios, right? So when I think shorter duration, higher up in quality, when you think about which markets help you diversify your exposure to the US and maybe at attractive valuations, maybe they get a tailwind from some of these dynamics. And you think of markets like the UK, for example, in equities, or you think about which markets you don't want to own. And Japan in fixed income is one of those markets. You had already a trend, this exacerbates that trend, or at least doesn't preclude it. So you want to shy away from that. You want to shy away potentially from taking too much long duration risk in developed market bonds. You want to try to find some of the other markets where maybe they're at they still have the potential and the room for cutting rates. Some of those are in EM, and it becomes a lot more nuanced, and by definition becomes a lot more active, right? Yeah. So tying it back to your 60-40 point, it's like, okay, it's not static, and it's not simple. So it requires a lot more active management, a lot more nuance.
That's an excellent point. And actually, as I'm listening to you talk about risk, it's almost like we are having a rotating kind of I suppose there's a conveyor belt of risk, and there is some risk that's always there, but some comes to the fore, and I think that's how safety assets work. Is that we investors do prioritize and rank risks And I suppose they react accordingly. So I think that's an excellent point also about diversification. Well, just to bring this to a close, I think we don't have a huge amount of time to discuss equity markets, but I think it's important for me to just comment on what's been happening in equity markets since they are the barometer. And we'll just close out with a quick comment on that. So a few things to say. Markets have been strong, as I mentioned, over this week, although this is a moving target. This one was cut off on April 1st. So Wednesday, we still have had reasonable volatility in markets as we've had at the president's speech in the evening of Wednesday, and markets did react negatively to that. But the strength of markets has been a bit of a surprise, reflecting some either the money on the sidelines wishing to move in with a sense of FOMO, but the underlying fortitude that has been there. And the chart on the right speaks about earnings and how earnings have been doing the heavy lifting and that forecasts have been strong. Again, another backdrop to all of this has been AI, job cuts. We've heard a lot about quite significant job cuts, even kind of whole philosophical rethinking of how middle management works. I mean, it's been a big move. There's been a lot of news flow that has perhaps gone beneath the radar screen because of the conflict at the fore. We know that projected EPS has still been high, and that we actually have a pretty strong earnings forecast underneath. So that has been an underpinning for some of the equity market strength. In terms of another sign of equity market strength has been the ongoing buzz around big IPOs coming in the pipeline, whether it's SpaceX, Anthropic, OpenAI. We have a massive fundraising going on by all of these companies, particularly OpenAI, and we spoke about that last week in terms of some of the guarantees they're giving to their private equity backers. So massive fundraising going on that really dwarfs even what an IPO could raise. And then perhaps in another sign of the expansion and the risk appetite, just saw a sign about Franklin Templeton, a very established asset manager, agreeing to buy a crypto spin-off. So clearly there's a lot of digital assets kind of on the fringe there. And my last slide had been about the sell-off and the shape of the sell-off, that this really doesn't even register in terms of some of the other sell-offs that we've seen. Certainly we're starting at a higher peak. And this is the FTSE here we're looking at, but we could look at any in the index for the same thing. We know that there have been sell-offs in the past, but this is only the fifth largest of the decade. So very strong underpinning when it comes to equities. And I suppose just to close us out then, Christian, and I'll stop sharing at this stage in terms of the screen. Any kind of concluding thoughts on equity markets and your how you take this, maybe some of this dissonance? We've talked about the uncertainty, but yet markets remain very strong.
Yeah, you're right. And I love your charts and what you mentioned about earnings and AI and some of the tailwinds. But basically, earnings doing the heavy lifting. I think that's absolutely a crucial point. And when you think about the expectations for earnings growth this year, they're extremely strong. Already at the start of the year, they were strong. They have been revised higher, right? So, and a lot of what is behind that is actually AI capex or AI related and technology driven. So in a ways, yes, it makes sense, and that's the reason why the market maybe hasn't panicked so much, saying, okay, the corporate sector and were robust coming into this. So far, you have not enough of reason to challenge that. Is something definitely to watch. I mean, you have earnings expectations of 17% year on year for full 2026 in the US. And they have gone up, as I said. Normally they tend to drift lower. And I think maybe just to close, something I found interesting yesterday, speaking to the strength of the equity market, is yesterday we saw oil move significantly higher again, right? So retest the highs, basically was up 10% or so on the day. Equities were flat. Say 2 weeks ago or 3 weeks ago, we would have seen a day at least 2% down in equities. We had the initial sell-off, recovery into the close, which is particularly important considering that you have a long weekend, right? And we have been sort of become more accustomed to get headlines or market moving headlines during the weekends. So I found that quite interesting, and that predisposition perhaps of market participants to try to buy the dip. And as you described, the fortitude. So we shall see whether that proves right or wrong. The risk is still there, but I think it's interesting to see how markets are trying to interpret this.